Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the Wall Street jungle. And today we're diving deep into Axon Enterprise Incorporated's latest quarterly report. Get ready because this filing is quite the roller coaster with some big wins and some interesting financial acrobatics. Before we dive in, if you are all about decoding these financial documents and getting the real story behind the numbers, make sure you hit that subscribe button. And if you want to chat about these findings with fellow finance enthusiasts, join our Discord community, the link is in the description below. So Axon reported total assets of over $6.6 billion as of the 30th of September 2025. That's a massive jump from around $4.4 billion at the end of 2024. This really tells a story of a company growing fast, likely through smart acquisitions and a solid increase in their product lines. Let's talk about the top line, the revenue. For the 3 months ending the 30th of September 2025, Axon pulled in over $710 million. That's a pretty sweet 30.6% increase compared to the same time last year. Now, looking at the 9-month period, their revenue hit nearly $2 billion, up a solid 31.5%. This growth is being fueled by both their familiar Taser devices and their booming software and services division. But how much of that revenue is sticking around as profit? The financial tables show their gross margin percentage was about 60.1% for the 3-month period, which is only a tiny dip from last year. For the 9 months, it actually improved a bit to 60.4%. That's pretty darn good, especially when you consider global tariffs and other costs. It shows they're managing their costs effectively while still growing. Now, for the cash going out for running the business, selling, general, and administrative expenses, what we call SG&A, went up significantly. For the 3-month period, it was over $252 million, a big jump from about $192 million last year. That's a lot more money spent on things like marketing, sales, and general overhead. This increase is largely due to hiring more people to keep up with growth and a big jump in stock-based compensation, which is basically paying employees with company stock. And on the innovation front, research and development expenses also shot up. For the same 3-month period, they spent over $176 million on R&D, a huge increase from about $114 million last year. This means they are heavily investing in new products and technologies. It's fantastic to see this kind of investment, but it also means they need these new products to really pay off. With all these costs going up, it is no surprise that Axon reported a loss from operations of over $2 million for the 3 months ending the 30th of September 2025. That's a stark contrast to the over $24 million operating income they had in the same period last year. For the 9-month period, their operating loss was about $12 million, compared to an operating income of over $74 million in the prior year. This is where we see the impact of all that increased spending on SG&A and R&D. They are clearly investing for future growth, but it is impacting their short-term profitability. Here is something interesting. Interest income was over $23 million for the 3-month period, way up from about $12 million last year. This likely comes from their growing pile of cash and short-term investments. They've got a lot of money working for them. But on the flip side, interest expense has exploded. It jumped from just $1.6 million last year to over $28 million for the 3-month period. This is a direct result of issuing those new senior notes, the 2030 and 2033 notes, totaling a massive $1.75 billion. This means they are now carrying a lot more debt. In their other income net line, we see a significant change. This section often includes gains or losses from investments and other financial activities. For the 3-month period, it was about $22 million, down from almost $45 million last year. However, within that, there were big swings in investment gains and losses. They had a substantial gain related to strategic investments, but a much smaller gain on marketable securities compared to the previous year. This volatility in investment income highlights how much it can impact their overall bottom line. Now, for a bit of a tax curveball, for the 3 months ending the 30th of September 2025, their tax provision was almost $18 million, which is higher than last year, but the rate they paid jumped dramatically to over 113%. The company explains this is largely due to new legislation called the One Big Beautiful Bill Act, which reduced their R&D tax credits, and also because their pre-tax income was much lower this quarter. When your taxable income drops, even small tax items can make the tax rate look sky high for the 9-month period. They actually recorded a benefit from income taxes, which is a tax refund or reduction of over $36 million. This is largely thanks to big tax benefits from stock compensation and R&D tax credits. It's a complex picture here with taxes. All of this leads to their net income or loss. For the 3 months ending the 30th of September 2025, Axon reported a net loss of over $2 million. This is a significant drop from the net income of over $67 million they reported the previous year. For the 9-month period, net income was around $121 million, down from over $241 million last year. This shows the impact of increased expenses and the absence of some of the large investment gains they saw in the prior year. Looking at the balance sheet, total current liabilities decreased slightly to around $1.3 billion from over $1.6 billion at the end of 2024. This is good to see, as it means they've managed their short-term obligations better. However, their long-term debt has ballooned. Total long-term notes payable are now close to $1.8 billion, up from zero at the end of 2024. This is all thanks to those new senior notes they issued. This is a massive increase in leverage. Their additional paid-in capital, which represents money invested by shareholders beyond the par value of stock, has also seen a significant increase. It jumped to over $2.2 billion from around $1.6 billion. This is likely due to the equity they raised through their the market offering and potentially other share issuances. When we look at stock-based compensation expense, it's a major factor. For the 3 months, it was over $146 million, a substantial increase from about $101 million last year. For the 9-month period, it's over $425 million. This is a big expense, but it's also a way Axon incentivizes its employees. Now let's talk about the risks. Axon explicitly lists a ton of risks. One major theme is their heavy reliance on law enforcement agencies. If these agencies decide not to buy their products anymore or face budget cuts, Axon's business could suffer greatly. They also highlight the rapid pace of technological change and the risk of new competitors emerging, especially with the growing role of artificial intelligence in their products. They mention product liability litigation, particularly concerning their taser devices. While they aggressively defend these and say past settlements haven't exceeded their self-insured limits, these lawsuits are always a potential financial and reputational risk. They also have a patent infringement suit against Drone, which is now part of Axon, related to drone technology. Looking ahead, Axon has made some significant subsequent events, meaning things that happened after the 30th of September, but before the report was filed. Most notably, they acquired the remaining shares of Invictus Apps, Incorporated, a company focused on AI-powered emergency communications software for a base price of $637.5 million. This is a huge move into AI and a significant acquisition. And if that wasn't enough, they also announced plans to acquire Carbine Limited, another emergency communications platform for $625 million. These two acquisitions signal a major strategic push into advanced communication and AI technologies. It's clear Axon is playing the long game, making big bets on the future. Finally, there is a stern note about an ongoing material weakness in their internal control over financial reporting related to revenue recognition. They are actively working to fix this, but it means they acknowledge there is still a risk of misstatements in their financial reports. This can erode investor confidence. And they mention that past restatements of financial statements have already impacted investor confidence. So, what's the story here? Axon is a company experiencing explosive growth, driven by innovative products and strategic acquisitions. They are spending heavily on R&D and expanding their team, which is impacting short-term profitability. Their revenue is climbing and their core gross margins remain strong, but the huge increase in debt and that operational loss are definitely points to watch. The big question is whether their massive investments in AI and new technologies, along with these significant acquisitions, will pay off in the long run and outweigh the current costs and risks. They're making bold moves, and investors will be watching closely to see if these bets pay off. That is our deep dive into Axon's latest report. What do you think about their aggressive growth strategy and recent acquisitions? Do you see these moves as a sign of future success or a risky gamble? Let us know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more corporate financial investigations. And don't forget to join our Discord community for more discussions. Thanks for watching, and we'll see you in the next Decode.